Welcome to Market Monday from the investment team in the trust department at the First National Bank. While there are not a ton of data points coming out over the next couple of weeks on the economy, what is coming out is consequential. So we're going to start by discussing those and what the implications for markets are. We'll discuss the market's performance recently and actually the resurgence of volatility, which we had called for a couple of weeks ago and seems to be accelerating. What the implications are for investors with that. We'll talk about the rates environment and then close with what it all means for an investor. So starting out, tomorrow we're going to get information on the labor market, which obviously if the labor market's coming in strong, that's good for the economy. If it's weakening, that's bad for the economy. So it's interesting to watch in light of especially quite a few data points that show some cracks in the resiliency of the economy lately. We get information on consumer prices later, producer prices as well. And this is really notable stuff here because a lot of the data that we've been seeing suggests inflation, far from being, decelerating, is actually accelerating. It's getting faster growth. And the market seems to, these show the consensus analysts' expectations. That shows a 0.3% increase versus a 0.5% from the prior period, which would indicate that they're expecting things to show a little bit of slowdown in the rate of growth in prices. Producer prices is even more notable. That's 1/10 on the month over month and then 0.3 on the year over year, expected to show slightly slower than prior growth, but still, pretty strong growth. However, with all of the data coming in that suggests inflation is high and likely to remain high, potentially even that it's growing, the odds are not that great for this expectation to be met. And if those numbers come in hot, we could see that really exacerbate what's already turned out to be a pretty turbulent March. Initial claims, we get more information on labor market, sentiment indicators, retail sales. These augur demand conditions and say, are consumers buying? Are they buying in a lot of goods? And in particular, when you take out auto and gas, are they buying, typical consumer goods? And yes, the expectation is yes on a month-over-month basis. Now, that's a volatile number. Overall, demand has remained relatively robust across different businesses, but it is worth noting that this is 2/3 of GDP growth, so we're paying attention to what the consumer's thinking, and we're paying attention to what the consumer's doing. The main event really is going to be the Fed's rate decision on the 19th, and that's expected to be unchanged. So they're expected to leave rates where they are, probably give some commentary about quote-unquote risks are balanced, or maybe that risk is a little bit more heavily weighted or skewed to the downside in their view. They'll make a press conference, a statement about what their view is, and we're expecting it to show some interesting ideas, because if inflation's actually resurging, which it looks like that is, their hands are a bit tied in terms of lowering rates because they continue to lower rates, and that just stokes inflation. So, if they start giving us commentary about a weakening economy being a risk, but their main policy tool is unavailable because it's inflationary and we're seeing a resurgence in inflation, there's a term for that. That's called stagflation. We had it in the late 70s up until 1981 when Paul Volcker, the Fed chairman at that time, famously came out and said that we were going to do whatever it takes to beat inflation. And at that point was when inflation started to really come under control. So the last time we saw an environment where, inflation was high and the economy was weakening was in general, decades ago. And so not a lot of people on Wall Street or in the analyst community or portfolio managers have been in their seat that long to have lived through those markets, and it might cause interesting things to happen in the market if we see those conditions. And the Fed's statement is likely to telegraph whether that's starting to become their view. So we're watching that keenly. We're going to get more information on real estate, and that rounds out our data. Let's talk about this. So the S&P 500, for a good while, this chart only goes back a year, so we're not capturing the bottom of the last bear market. But looking at this, we've seen a general upward march up until the end of the year last year, where the market really couldn't get past this 6,100-ish area. And now we're back up there again a couple times, and no, and now we're rolling over. And what's more interesting than the fact that we're rolling over is, there's a thing called average true range. It's not displayed on this chart, but you can just tell when you start seeing lots of very big bars instead of over here. When you're seeing an advance where most of the bars are relatively small, this shows expanding volatility. And generally, this type of toppy behavior where you have a big down day followed by a big up day followed by a big down day followed by a big range day, a big range day, a big up day and down day, this isn't healthy market behavior. It suggests that we might be seeing a turbulent March, maybe even a market event where fear gets blown off. And the VIX index, this is the volatility index, and it takes what are big institutions doing in the S&P options market as far as buying protection, and this is at 26.39, and that's a relatively high level even by our normal standards over the past few years, and it suggests anything over 25, we probably want to be paying attention, and we want to probably be girded for a little bit of turbulence. So we're watching that, but it doesn't suggest placid markets. And when we look at the rates, these are the Treasury yield curve rates. There's a notable flattening of the curve, which isn't great to see either, because flattening comes before inversion. We would obviously prefer to see this kind of slope increasing, not decreasing, and it is maybe out here on the 20-year end. But with that said, investors have been, it appears, if you look at the S&P 500, that's come down a decent amount, and in the same time, over like a month, rates have come down, let's see here, 1 month, 35 basis points mainly, in the belly of the curve, and 30 basis points-ish all the way out to 10 years. That suggests that in the large investors are doing what's called a flight to quality trade. You have investors buying protection in the options market and also selling stocks and buying bonds. So, in the context of a weakening economy, we're a little bit cautious here, and we're wanting to pay attention to all these data points and get a read on what's going to happen. Corporate rates on A-rated paper is looking great. This is the type of a shape of a yield curve we'd really rather see. And rates have actually gone up a little bit on the longer end of the curve from a year, not really down a heck of a lot over the past month. So, that suggests that corporate bonds are not seeing a big increase in credit risk. If anything, maybe the credit conditions of companies are increasing because these bonds are priced what's called spread to Treasury. The Treasury bonds inputs for its pricing and yields is basically just inflation expectations, and performance of the economy is kind of a derivative of that. In looking at this, there's also, you take that yield and then there's added a certain spread, they call it, which accounts for the credit risk of individual companies. So if the Treasury bond 5-year has gone down 33 basis points and the corporate's only gone down 17, that suggests that the corporate credit quality outlook is actually strengthening a little bit even as we see weakening economic conditions. So that's an interesting conundrum. We're not sure what that means yet, but that is kind of what the math behind these pricing models is saying to us. Anyway, these rates are still great by historical standards in the past 20 years or so. Almost 5% here, 5% and up once you get out past the 5-year bond. And that allows income investors to do well, to get paid a decent income in coupon payments. And it also, if you're in a balanced portfolio and you're trying to hedge away volatility in the equity market, you're going to, be getting paid to do that. Coming back to the S&P, seeing this type of turbulence, it's interesting to note also, we called this out in the last Market Monday, March is one of two periods in the year where you tend to see markets pull back and have turbulent rides. The other one being September, October. And, we're not sure why that happens, but just historical probability-wise, these events tend to cluster in those two periods. So, what we're seeing is not all that unusual, and it's nice when the market is taking a breather. We've had this relentless push up. If I pull up a 5-year chart instead of the 1 year, and this is a very big rise off of 2019. We consolidated after 2022's bear market. It was like October in there when we had the bottom, and then it's just done nothing but kind of go up. So every once in a while it's healthy for the market to pull back. There's not a catastrophe looming on the horizon, although market fears may become elevated and people may be talking about it and maybe even panicking about it. We want to maintain a long-term view. This is even only a 5-year view that includes the market in 2020, a full bear market in 2022, which is a 20% decline in equities. And these rides that happen, sometimes it's up, sometimes it's down. What we're seeing is not altogether unusual. And if we spin this out to a 20-year period, it's even more pronounced, this effect. So what are the implications for you as an investor? You really got to ride out the volatile periods and stay put. We advise that you really never ever make changes to a long-term investment plan based on short-term market events or outlooks. Now, if something major and material happens, maybe it's time to tilt strategies. And we do have something major happening. The world is changing in a way that's basically eliminating globalization as a philosophy, a lot less cooperation among major powers, and the reinstitution of mercantilist ideas like tariffs, as a foreign policy tool. And when things like that happen, it's a profound change from when everyone's cooperating together. So we're looking at the implications of that, but market-wise, the markets are very resilient, and they're always going to find a way to thrive and flourish under whatever the environmental conditions are, and that's just an environmental condition that's changing a little bit. So will it tilt our investment plans over time? That remains to be seen. For now, no. But eventually that may change. But it's based on a long-term view, and that long-term view is becoming more and more cemented. It's looking less and less likely that we're going to be able to get past all of our differences with the different nations of the world, and they're going to be able to get past their differences with us. And it's just a different us versus them mentality out there in the world, or what you might call every person for themselves. But in any case, the thing to do as an investor is methodically stick to the good long-term plan that's designed specifically to achieve your financial goals, whatever the conditions are. So hope you found the video useful. If you want to chat about markets or the economy or your accounts, feel free to give us a call. We love to talk about that stuff. Thanks. Have a great day.